In Module 4, we will begin to turn our attention to the concept of risk and return. This is an essential concept in investments, and we will look at how rates of return are calculated, the difference between different rate of return calculations, and how interest rates and rates of return change in accordance with the risk on a particular investment. The last two quotes on the two slides just previous are quotes that I've taken over the years that I feel really to be true with regard to how investors deal with the markets. It really has to do with how much you know about the markets, but often has so much to do with how much you understand about the risk of the markets. And that really means the volatility of the market. You have to understand that when you invest in the markets, your investment value is going to go up and down, and you have to be able to stomach that in order to take those investments. If you can't, then your psyche may cause you to make decisions that are not necessarily the right decisions to make. So an understanding of this whole risk-return concept is extremely important in investing. So the first thing that we'll talk about is the real rate of return. And we know that inflation erodes the purchasing power of our money. So I'm going to read to you what's on the slide, and then I will elaborate on it. We know that the return on investments is affected by inflation. We also know that if we made a 10% annual return on an investment, it is not necessarily so that our money invested would be able to buy 10% more goods. This would depend on the inflation that has occurred during the time our investment accumulated this return. So in order to arrive at the real rate of return, we have to take this inflation into consideration. If we've made a 10% return, but inflation has gone up 3% during the time that return has been accumulated, this means that the return that we actually got, the actual amount of goods that we could purchase with this, is less than the 10%. And I'll show you in the next slides how to calculate the difference. So first, some terminology. Inflation is measured by the CPI, the Consumer Price Index. So that's where we get the inflation figure that we're talking about in these calculations. And our real rate of return is defined as the rate of return that has been adjusted for inflation. We use the term the nominal rate of return to identify the return before inflation. It's often called the stated rate of return on the investment. So nominal is before inflation, real is after inflation. So real equals nominal minus inflation. The Fisher equation basically states that if investors are interested in their real rate of return, which they are, then with any increase in inflation, investors will require that much higher nominal rate of return, or stated rate of return on their investment. So, if your nominal rate of return is 10% and inflation has been 2%, then your real rate of return is 8%. Now, if inflation increased to 4%, then in order to maintain an 8% real rate of return, we would require a 12% nominal rate. So essentially, all we're saying is that the rate of return that the investor is really interested in is the real rate after inflation. So we want our nominal rate to be whatever it needs to be to provide us with the real rate that we require. So the question you might ask then is, how do we know what rate of return we require on a particular investment? And the answer is that it depends on the time frame. The rate of return an investor must earn on an investment to be fully compensated for the risk that they're taking is its required rate of return. So in order to determine at any given time what the required rate of return is on an investment, we have to know what rate of return is an investor currently getting for an investment that is considered essentially risk-free. This would be something like a T-bill. And then we also need to know how risky is the investment that we're talking about, because we need to attach a premium for the amount of risk that we're taking. So if we have two investments, mutual fund A and mutual fund B, and mutual fund A is fairly low risk. Mutual fund B is quite aggressive and therefore quite high risk. The risk premium would be higher for mutual fund B than for mutual fund A. Both of the mutual funds would have to get at least the risk-free rate because both of them are taking more risk than the risk-free, so they need at least the risk-free plus some premium, and the premium depends on how risky that investment is. On the previous slide, we talked about what the required rate of return was. So we can sometimes estimate what the required rate of return on our investment is at any given time. Next, I'm going to look at the calculations that we can do that tell us what our actual rate of return has been on an investment that we've held. The first calculation that we do is something called the holding period return. And the holding period return measures the return on an investment over any period of time. Most returns are presented to us in the time frame of a year, usually annual returns. But we know that we hold investments sometimes for less than a year and sometimes for much longer than a year. So if we are only discussing the return on our investment for the period of time that we held it, regardless of the time frame of that period of time, then we're talking about our holding period return. This can be difficult to compare to other returns because we would have to compare to another return for exactly the same holding period, so we tend to put things in terms of an annual return so that we can make those comparisons. However, the holding period return, in order to do the calculation, is very similar to any of the calculations we've done so far. We always want, when we're doing a rate of return calculation, to figure out how much money have we made and then divide that by what we invested to make that money. In the end, that's all it is. So in this case, to figure out how much money we made, we compare the ending price to the beginning price. This would be the amount of our capital gain, plus any income that we've received from the investment over the period of time that we've held it. All of this together is our earnings divided by our beginning price. And I've made a note here on the slide that the income that's received may have been in the form of interest, dividends, or it could even be capital gains distributions from a mutual fund. We'll talk about that a little later on in the mutual fund section. I have an example here of a holding period return calculation. In this calculation, the stockholder purchased the stock in 2001 and held it for 3 years, selling it at the end of 2004. The prices and dividends are as follows. So if the investor purchased it in 2001, they paid $32 a share to purchase it. In 2001, they received $1.40 in dividends. In 2002, $1.60. 2003, $2. And then in 2004, they received 90 cents. At the end of 2004, they sold the shares for $39 a share. Therefore, our calculation is the difference between our end price and our beginning price, 39 minus 32, plus all of the income that was received on the shares over the period of time that they were held, $5.90, all divided by the initial investment amount of $32. The return then over the full 40 years is 40.31%. So we would say that this investment had a 4-year holding period return of 40.31%. Next, we're going to look at a calculation called the annual percentage return. And I mentioned before that we tend to put things in terms of annual returns because this is what allows us to compare our returns to other investments. We use the annual percentage return calculation when we're dealing with a holding period return of less than a year. We're converting this less than a year figure to a yearly figure. So the annual percentage return uses simple interest to do this. If the holding period return for a 1-month investment is 1%, we simply would multiply that by 12 to get the yearly. So 1 times 12 would give us a 12% annual percentage return. The effective annual return, on the other hand, is also a method of converting a less than 1-year return to an annual return so that we can make those comparisons. But in this case, we are taking into consideration compounding. We're taking into consideration the fact that when we make an investment for less than a year, we can invest in that for that same time period over and over again until the year is up, and every time we do it, we can take the earnings that we have just earned and reinvest those as well. So the effective annual return using compounding is calculated as 1 plus the rate of return for the small holding period to the power of n, where n is the number of holding periods in a year, minus 1. So for our 1% per month example, we would calculate the effective annual return as 1 plus 0.01 for 1% to the power of 12, because there are 12 one-month periods in a year, minus 1. So this equals 12.68%. Because the effective annual return takes into consideration compounding, it will always be higher than the annual percentage return on any investment.